5. Now, if you're a mortgage holder and we're hoping to hear news of an interest rate cut this afternoon, you'll have to wait a little while longer. The Reserve Bank of Australia has decided to keep rates on hold at 4.35%. Head of the RBA, Michelle Bullock, says inflation is still above target.
We've considered in detail whether our current settings are sufficiently restrictive and judged that based on what we know at the moment, rates will remain on hold for the time being. Inflation has come down a long way since it peaked in 2022, both in Australia and overseas. Part of this was the resolution of supply chain issues and energy prices easing, and monetary policy has also been doing its job. But inflation is still above our target, and it's proving to be sticky. Progress in getting underlying inflation down has slowed, and it's likely to have remained slow in the September quarter.
So that's Head of the RBA, Michelle Bullock, explaining the decision this afternoon. Leith Van Onselen is Chief Economist at macrobusiness.com.au. Leith, hello.
G'day, Kelly. How are you?
Good. This is pretty much what we expected. And is the reason why what you expected as well?
Yeah, it is. It is. I mean, pretty much all economists are expecting rates to remain on hold, which, obviously is what happened. Although what I will say is, though, I think the decision was a little bit more hawkish than, looking ahead. Mm-hmm. So, the Reserve Bank basically ruled out any rates cuts before the end of the year, pretty much, which there were some economists holding out, hoping that we'd still get rate cuts before the end of the year. CBA still tips rate cuts by December, but I think Michelle Bullock's pretty much hosed that with these statements.
So with that, she was talking about the inflation rate being sticky. So it's obviously refusing to kind of move as quickly as everyone would hope. What's keeping it sticky?
Yeah, well, we've got a whole range of areas. You obviously have high energy prices. It's also got the rental costs. Rental inflation remains very high, and so does housing inflation. But those are the sort of domestic factors that are keeping inflation sticky. But also we have record government spending at the moment in the economy. So government spending as a share of GDP is actually at its highest level ever. And according to Westpac, it's going to rise even further. And a lot of that relates to, obviously, the massive infrastructure, big builders by state and federal governments, as well as the NDIS and those sorts of things. So there is a lot of demand being pumped into the economy by the governments, by the various governments, I should say. And this is coming at a time when, obviously, the Reserve Bank's trying to slow the economy. Yep. And that's obviously, putting upward pressure on inflation. We've also got very high population growth through immigration at the moment, which is also keeping upward pressure on inflation. And the Reserve Bank minutes actually alluded to that. They said that the household spending has fallen, that the economy is incredibly weak, but we've had growth in aggregate demand from high spending by temporary migrants, such as students. So that's basically saying that although the individual households are coming back, the overall economy is expanding because of this high migration that we've got.
So it sounds like a whole lot of things that the average person can't do anything about.
No.
Are keeping interest rates up, which makes us feel a little powerless, I think, in this big, messy scheme of things.
Yeah, it does. And unfortunately, the problem with interest rates is that it's a very blunt instrument, and it only impacts directly about 1/3 of households. So those are 1/3 of households with owner-occupier mortgages. And then we have 1/3 who rent, who obviously aren't impacted by interest rates per se, but they're impacted by high levels of immigration. And then we have 1/3 of households who own the homes outright who aren't impacted. So unfortunately, we're smashing 1/3 of Australians basically with mortgages to try and get overall inflation down. Yep. And unfortunately, it's not the greatest way to do it, but it's not the RBA's fault. They only have one tool, which is interest rates, and it's really up to the federal government to try and, pull the levers there to try and get inflation down.
Leith Van Onselen's Chief Economist at macrobusiness.com.au. We're talking about the Reserve deciding to keep rates on hold at 4.35%. But as you mentioned, they've been hawkish about this in that they've said, nothing's on the table. So what do you think the chances are of even a possible rate rise?
I think a rate rise is very, very unlikely. But I think rates will remain on hold until next year. And I honestly think, Kelly, that the federal government is going to be sweating bullets about this. Yep. Because they're going to go to an election before May next year, or by May next year is the deadline. And the rest of the world's cutting interest rates. So the US, UK, New Zealand, Canada are all in interest rate easing cycles, and Australia isn't. And obviously there's all this concern about cost of living, etc. There's a lot of pressure on the government. And I think they are banking on the Reserve Bank to cut rates before they go to the election, and there's a risk that they won't. And I think this is why Jim Chalmers has been stepping up the rhetoric, trying to say that the RBA is smashing the economy, etc., etc. But the RBA is basically throwing it back in their faces today with this statement, saying that no, inflation's too high, and we're going to keep it on hold for the time being.
So with those other economies that are cutting rates, as you mentioned, the US, the UK, New Zealand, what did we do differently, or are we doing differently, or is the Reserve looking at differently to those countries?
Well, we did start hiking rates later than those countries. Mm-hmm. So Australia was a bit later to the interest rate increasing table, I should say.
Yep.
So it just seems like we're going to be late on the way down. But as I said before, we do have those sort of domestic factors that are pushing up costs. So obviously we have massive government spending, through the NDIS and infrastructure, etc. But also we have this high energy inflation because we've got this broken gas market, unfortunately, on the East Coast. And we also have obviously extremely high immigration, which is pushing up housing inflation. So these are sort of domestically driven factors which are unique to Australia that are pushing up, keeping inflation higher and keeping interest rates higher for longer.
Is this why we're seeing some of these, for example, NDIS packages, aged care packages, where they're really not delivering a lot of them until June next year? Is that to try to keep some of that money out of the economy prior to an election? Yeah,
it could be, but the NDIS is growing at about 20% a year at the moment, so it's over $40 billion expending, so it's huge. And the Parliamentary Budget Office predicts it's going to be about $100 billion in a decade. So we're talking massive sums of money here, and that's obviously so. This massive NDIS spending is actually driving just about all of Australia's jobs growth as well. So we have a situation whereby the private sector in Australia is in a very deep recession, but the public sector is growing very quickly, and as a result, the overall economy is growing slowly. But once you strip out population growth, it's still going backwards. Yep. So it's a very topsy-turvy economy at the moment, whereby the private sector is getting absolutely hammered, but the overall economy is getting supported by this massive government spending. It's not really sustainable, but it's sort of papering over the cracks. Yeah,
well, I mean, retail's in a mess. Like retail is had 6 months or 6 whatever it is quarters of negative growth. Well, retail's hurting.
Well, actually, we've had negative 6 quarters in a row of negative per capita growth. So once you strip out population growth, it's going backwards to 6 quarters, which is the longest decline on record. It's not the deepest. The early 90s recession was worse in terms of severity, but this has been the longest. And also, we've also had household incomes have fallen by about 8% in 2 years once you strip out population growth. So it's been a really nasty 2-year period, and households are getting absolutely smashed, but some of their activity's been offset by this huge government spending.
And I suppose the US as well, they have loans that are set, fixed rate rather than variable like ours, which means interest rate rises don't really have as much effect as they do here.
No, unfortunately for Australians, we have the highest share of, or one of the highest shares of variable rate mortgages in the world. And the US is the complete opposite. They're primarily 30-year fixed.
Yep.
And what that's meant is that whenever the Reserve Bank increases or cuts rates, it flows straight to households almost directly, straight away. And we are sort of unique like that. And that's one of the reasons why the RBA hasn't hiked rates as aggressively as, say, New Zealand, for example, or the United States. Because we have a much higher share of variable rate mortgages. So although they haven't hiked it as far as those places, it's impacted us more than a lot of those places.
Yeah. Leith Van Onselen, thank you so much for your time this afternoon. Appreciate it.
Thanks, Kelly.
Leith Van Onselen, who's Chief Economist at macrobusiness.com.au. Interest rates